So here we are now at the next unit. We're going to be talking all about retirement accounts. So here's a cartoon. Investments in retirement planning. If you work hard and invest wisely, you can afford to turn 65 on your 80th birthday. Traditional IRAs. This is where you can put up to 100% of earned income up to the annual max, plus a $1,000 catch-up if you're over the age of 50 years old. In 2018, when this is being recorded, that annual max is $5,500. But that could change year to year, and those types of numbers are not tested. I do have a list of the tax numbers. If you are interested, you can find them online, but don't worry about them. You're going to be able to have that list with you whenever you talk to a client. You can look it up on your phone to just make sure if you're ever questioning. That's one of the things. You don't need to worry about memorizing those specific numbers for this exam. There's a spousal option for non-working or low-earning spouses, where it allows a non-wage earning, a stay-at-home spouse, to contribute up to their annual limit. Their partner is able to contribute on their behalf to their actual individual IRA, even if they actually do not have any earned income. Because if you think about it, if there's a stay-at-home spouse and a working spouse, and the working spouse is the only one able to contribute to an IRA, they're only going to have half as much money as they should otherwise have when they retire. There are tax-deferred growth. We're going to get into the fact that pretty much all retirement accounts that we really need to worry about have what's called tax-deferred growth. That means that you're not paying the taxes each year. They're deferred, put some time into the future when you retire. You're going to be paying the taxes when you retire. That's different than being tax deductible. We're going to discuss that momentarily. There are premature withdrawal penalties, all retirement accounts, and that includes annuities. Prior to age 59 and a half, if you take the money out, not only are you going to be subject to the taxes then, there's also going to be a 10% penalty. But there are some exceptions that we're going to get to very shortly as well. There is required minimum distribution. We're going to get into the idea of qualified money and plans versus not qualified money and plans. Qualified money is money that has not been taxed yet. That means the IRS has not gotten any of their money. If you know anything about the IRS, they might be a little bit patient in certain ways, but they want their money, and they're going to get their money. And because you haven't paid any money on this, any of the plans that are tax deductible, that is where you're not paying taxes on the contributions when you make them, including traditional IRAs, they're deducted from your income. For those plans, there are going to be the RMDs, where at 70 and a half, you have to start taking withdrawals. There's a calculation based on your age, life expectancy, amount of money. Don't worry about that. Your broker-dealer is going to tell you about that. But you have to do it. Now, as we know, the IRS is very reasonable. And if somebody doesn't want to take the money out and pay the taxes, the IRS has a very reasonable plan. Let's say you're in the 30 or 35% tax bracket and you don't want to take out the RMD of $1,000 because you don't want to give the government $300 or $350. The IRS understands, and they are very accepting. And instead of you taking out $1,000 and giving them $350 or $300, they're simply going to take $500 as a penalty. You either are going to pay the taxes, which are 35, 37% worst case, or they're going to give you a 50% penalty on what you should have taken. As I said, very reasonable. You're either going to pay us something or we're going to take a lot more. That's why you always want to take the money out. RMDs, you always do it. It's always better to withdraw and pay the taxes than deal with that 50% penalty. It is qualified money, as I said, so it is tax deductible contribution. It is not a qualified plan. We're going to get into what a qualified plan is. That is only between employee and employers. It cannot be a private individual plan like a traditional IRA is. That's why a traditional IRA, although it's qualified money, is not technically a qualified plan. Roth IRAs are the other basically individual account. These have the contributions that are the same as traditional IRAs. That is $5,500 in 2018. You have the catch-up. and the contributions are subject to income limits. Technically speaking, both traditionals and Roths have income limits. The difference is, with a Roth IRA, if you're over the limit, you simply cannot contribute anymore. With the traditional IRA, if you're over the limit, that contribution is no longer tax deductible, but you can still make the contribution. These are after-tax, non-deductible contributions only. Whereas with the traditional IRA, which is tax deductible, that means if I made $50,000 this year and contributed $3,000 in my traditional IRA, I'm taxed as if I made $47,000 this year. $3,000 less because I put it away. It's deductible. With the Roth IRA, I'm taxed as if I made the $50,000. Now, it's always the questions asked, should someone invest in a Roth IRA or a traditional IRA? It's a great question. I always follow up when someone asks is, do you believe that taxes are going to be higher when you retire or lower than when you retire than they are now? Because if taxes are going to be higher than when you retire than they are now, you'd want to pay the taxes now rather than later when they're higher. Paying the taxes now means a Roth if you think taxes are going to go up. If taxes are going to go down, it would be better to pay the taxes later. That's a traditional IRA. Okay, so if you think the taxes are going to go down, you should invest in a traditional IRA. Whenever someone tells me their answer to, are taxes going to be higher or lower, I always then follow it up with the second question in this case. Are you willing to bet your retirement on that? You think taxes are going to be higher or you think taxes are going to be lower. Are you willing to bet your retirement on that? Or might it be better to sort of put some money on the bet that taxes are going to be higher and some money on the bet that taxes are going to be lower, and basically then in retirement take from wherever you need to sort of help fix your income each year? I always recommend people look at both. People get both. There's no reason not to. These are tax-free distributions at retirement if the account has been open for at least 5 years. If withdrawals begin after 59 and a half. There's also a penalty-free withdrawal for first-time home buyers. That is only for a Roth IRA. That is a $10,000 lifetime cap. But qualified higher education expenses, disability, death, those are going to let you get access to Roth IRA money earlier. Same with traditionals. Traditionals just don't have the first-time home buyer exception. The other cool thing about RMDs is that, Roth IRAs, is that they have no RMDs. You've already paid the IRS the money. They're not getting any money. It's tax-free distributions most of the time. So they're not getting any money when you withdraw the money. They've already gotten their money. That's why it's non-deductible. You paid it when you deposited it. You paid it that year. So they don't actually make you take out money. You can keep a Roth IRA forever. You can actually contribute to a Roth IRA after age 70 and a half. You can't do that with the traditional. You can with a Roth. They don't care. You've already paid the taxes. They're generous like that. Once you've paid them, they don't care anymore. At least most of the time. Investments and financial planning cartoon again. I retire on Friday and I haven't saved a dime. Here's your chance to become a legend. Always did like that one. So now we're going to start talking about the actual qualified plans, the retirement plans. ERISA has minimum requirements for private sector plans must meet in order to be considered a qualified plan. All employees 21 years or older who have worked for 1 year full-time or for 1,000 hours or more must be able to participate. They can't pick and choose with ERISA. They can't what's called discriminate. Money must eventually vest, even if the employee is no longer employed there. You will see some explanations below about vesting. It's a weird topic, but the idea is when I put money in, my money is always my money. I can always leave and take it. If the company is putting money in, that may not actually be mine yet. It has to be there for a certain amount of time, slowly vesting. And eventually then it becomes all mine, and if I leave, when I leave, I can take that with me. But if I leave early, what's not vested, I don't get. But there's no discrimination. Now I've got some additional information below about this as well, where I talk about my old college university president. We all know that university presidents are highly paid in many cases. My first university that I went to, named Rensselaer, had the honor for a number of years of having the highest paid university president in the country, probably the world, knowing what they were paid. Just to give you an idea, if you ranked like first, second, third, fourth highest paid presidents, if you add up second and third, Rensselaer's president was paid more than second and third combined. She was paid more than twice second place. If you add in fourth place, they beat her, but not by much. And what I go and talked about in that animation is the fact of who this woman is. She's brilliant. She basically, cell phones, a lot of what we use in cell phones are basically her design. She was the first chair of the Nuclear Regulatory Commission. She was I think the second woman in the country to get a PhD, first from MIT. There's a long list of these things. But she's an African-American woman. Brilliant, brilliant woman. But when you think about discrimination, you think that an African-American woman would be discriminated against. When it comes to retirement, though, discrimination doesn't mean a negative thing. All it means is, in the case of Dr. Shirley Ann Jackson, the board of directors, the company she worked for, says she is the only one that gets to participate. We are discriminating for her. She is the only one that gets the benefit. That's the idea of discrimination in retirement accounts. It's not necessarily the bad phrase that we think of when we talk about discrimination in the regular world. The comparison between qualified plans, these are plans that meet ERISA guidelines, and non-qualified plans, these are plans that do not meet ERISA guidelines. With qualified plans, the contributions are currently tax deductible. All qualified plans have qualified money. Non-qualified plans, the contributions are not deductible. They're paying taxes that year in most cases. Qualified plans are tax-deferred growth, as are non-qualified plans. Qualified plans all withdraw their tax. You haven't paid any taxes on any of the money yet. All of the money when you take it out are going to be ordinary income tax, just like your regular salary would have been that you deducted and then deferred all of those years. Non-qualified plan, the excess over cost basis. CB is cost basis. Basically, think about that as your deposit, how much you put into it. That's what cost basis basically is. Anything over that, the growth of the account is what's taxed. But you're not taxed twice on your contributions. Your contributions were already taxed because they're not deductible in a non-qualified plan. The employer plan may not discriminate in qualified. The non-qualified plans absolutely do. That's the reason they exist. They're generally designed for highly compensated, very important directors, vice presidents, presidents of universities, things like that are who gets these non-qualified plans. With a qualified plan, it must be structured in the form of a trust. Non-qualified plans do not have to be in the form of a trust, though in practice many actually are. Qualified plans do need IRS approval. They come with lots and lots of taxable benefits. Non-qualified plans do not need IRS approval. They don't need that. The idea of a non-qualified plan, though, is that the employee, that the person cannot get what is referred to as constructive receipt. They don't actually have direct control over the money until they retire. There can be lots of strings on non-qualified plans. You really don't need to know much about them. To give you sort of a summary picture of qualified and non-qualified, we've got to remember the ERISA guidelines. All employees meeting the requirements must be able to participate. No discrimination, no picking and choosing who is able to and who is not able to join in this plan. The requirements can be no stronger. We're going to discover that they could be weaker, they could be less stringent, but they can be no more stringent than 111. That is 21 years old. That is 1 year of service at the company and 1,000 hours of work during that year. The vesting rule is that employee eventually will own 100% of all assets, even the employer's contributions, even what the employer put in, and even if they no longer are there. Now, when you leave a company, if you take the 401k or the retirement plan with you when you leave, chances are you're giving up some of that vesting. They're going to tell you when you leave you're giving that up. But if you just leave it there for a couple of years, you're eventually going to get all of the money that was put in there. Qualified plans are those that follow ERISA guidelines, that have qualified money in them. All qualified plans contain qualified money. 401k, 403b, SEP, Simple, Keogh, profit sharing, Those are all qualified plans. Qualified money is money that has not been taxed yet. It will grow tax deferred. When withdrawn, it's 100% taxed as ordinary income. You haven't paid any tax on this because it has been deductible. There's no cost basis in here. It's a zero cost basis. Now, all qualified plans contain qualified money, but not all qualified money is in qualified plans. There's that one exception we just talked about, traditional IRAs. That's why if you have a client in the future, after you get these licenses and start dealing with securities, and you have a client who is in one of these qualified plans, you're going to find that you can move them into qualified money, that's a traditional IRA, real easily, because they're basically the same structure. They're both qualified money, so you're not getting receipt and having to pay taxes. The non-qualified plans are those retirement plans that do not meet ERISA guidelines. They are not qualified money, meaning they are not tax deductible. There is a cost basis. Only the growth will be taxed. When you're looking for non-qualified plans, you're looking for a deferred compensation or 457, which is a type of deferred compensation. Define benefit versus contribution. You need to understand these phrases. A defined benefit plan is, you want to think of pension. The company defines a benefit, and then it has the responsibility to meet that benefit. It has to contribute to meet whatever the promise it made was. And these are going to be different from plan to plan. Defined contribution is where you want to think of 401k, where the company offers the employees the ability to withhold income, that the employee defines their own contribution, and then they can choose where to invest it in options the company selects. Now, I want to make sure we understand this. The company isn't selecting where you put your money. But if you've ever looked at like a 401k offering document or any of the information, you're going to see like a dozen or 24 different mutual funds that you could invest in. There are tens, hundreds of thousands of mutual funds out there. Those 10 or 20, whatever, dozen or two, those are the ones that the company selected. All different risk factors, all different investment objectives. They're all going to be different, but those are what the company selects. Then you as the employee defines your contribution and picks where you want that contribution to go. 401ks. These are pre-tax contributions. They grow tax deferred. This is qualified money, qualified plan. There is no mandatory matching. Most 401k companies do match. Most companies offering 401ks do match. They don't have to. The employee does pick where the money goes. And the employees are always 100% vested on their contributions. Most of the time when we're talking about vesting, we're talking about 401ks, because these are one of the more popular and well-known retirement plans out there. All withdrawals are taxable, just like any qualified plan with qualified money. Any withdrawal has not, since the deposits have not been taxed yet, all of the withdrawals are 100% taxable. There is no cost basis. These are qualified money, which means they have the 59 and 70.5 rule. The 59.5 because they are retirement, the 70.5 because they are qualified money, and all withdrawals will be taxable as stated. 403B. These are tax sheltered annuities, TSAs. They are pre-tax. These are qualified plans, qualified money. These are for public school employees, nonprofit hospitals, and churches. Contributions are made by salary deduction. Distributions prior to 59.5, again, it is a retirement plan. We'll have the 10% penalty. RMDs at 70.5, it is qualified money, a qualified plan. And all withdrawals will be taxable. It is qualified money, so all of the withdrawals are taxed. SEP IRA. Very rarely am I going to stress what the acronyms mean. A SEP is a simplified employee pension. The important word there is pension. These are for self-employed individuals and their eligible employees. The eligibility rules, well, we know what they are, right? It's 21 years old and, worked for the same employer 3 of the last 5 years. Remember, the eligibility rules with ERISA can be no more stringent, no more strict than 111. 3 of the last 5 years is less restrictive. It's more easygoing. It's less stringent. Perfectly allowed. they have received some IRS required amount. It's some small amount. I believe it's $600 as of 2018. You're not going to be tested on that. It's not relevant. They must have at least been paid some small amount from that employer. Clearly significantly less than 1,000 hours of work if it's around $500 or $600. I think it was $550 and now it's $600. But these are employer contributions only. That's why I was stressing the pension aspect. SEPs are a form of pension, as in the employer is the only one that's making contributions. The max contribution is the lesser of 25% of gross earnings, or the IRS limit. Distributions prior to 59.5 and RMDs at 70.5. The 59.5 and 70.5 rules apply. Qualified money, it's a retirement account, and all withdrawals are taxable. The simple IRA is a small business plan, as is a SEP, but a simple IRA is a limit of 100 employees. No more than 100 employees can be in a simple. Any employee that makes at least $5,000 during the previous year, that is their eligibility requirements. That's it, just the one. Employees may contribute to their account up to an annual limit. Unlike a SEP, a simple does have employee contributions. The employer must contribute either by the 2% method or 3% dollar for dollar. What I believe that means is they must either put in a flat 2% of all employees' salary, or they must put in 3% of the employee's salary, but only so much as the employee puts in dollar for dollar match. The employees are immediately 100% vested on all contributions. The vesting period here is immediate. All other plans have at least some vesting. The amount of time changes between them. It's unimportant, irrelevant. Simples, though, have no vesting period. They are immediately vested. Distributions prior to 59.5, RMDs at 70.5. All withdrawals are taxable. Then we have the Keogh plan, the least tested of all retirement plans. The last time you're likely to see Keogh is right before you go into test as you're studying, because you're not likely to see it on the test. But only self-employed persons or an employee of a self-employed person is eligible. No corporations can do this. The eligibility rules are the straight ERISA 111. Must be 21 years old, worked for at least 1 year, worked at least 1,000 hours during that year. The voluntary employee contributions are allowed up to the lesser of 10% of earned income, or $2,500. The max contributions are 25% of gross income up to the IRS limit. I believe it's like $55,000. Well, if it's $2,500 and $55,000, that seems really weird. But remember, this is only a self-employed person. If you've got a self-employed person, where does really the corporation and the person end? So it's like the employees can put money in and the corporation can put money in, but they're basically the same person. These are unincorporated. That's why the limits are weird. I don't really know much about Keoghs. Again, you're not likely to run into them that much in the real world, and you're certainly not likely to see them on the exam. Again, distributions prior to 59.5 have the 10% penalty, RMDs at 70.5, and all withdrawals will be taxed. Here's our new retirement plan. At age 65, we're going to get divorced and then marry other people who plan better. It's another one of my favorites from Randy. That brings us to the end of the retirement chapter. They are very important for the real world. They are definitely tested on the exams, not hugely. You do want to make sure that you recognize the qualified and non-qualified. But there are additional posts below. Make sure that you take a look at them, and I'll see you again shortly.